Okay, we are recording. I am calling to order the special meeting of the Retirement Board dated Tuesday, May 19th, 2020. I just have a bit of a public service announcement relative to how we are going to do these things. You just want to be certain that when you speak that you identify yourself. And also, too, when we take votes, we will go through and do a roll call. Just please state your name and aye, no, or abstain. I recognize that this is a bit clunky, but this is the way we need to do business in the near term. So with that, are there any questions from anybody before we proceed? Hearing none, I will move to the item 2 on the agenda, the approval of the minutes from December 4th, 2019. I will make a motion to approve the minutes. Is there a second?
Second, Elliott.
Is there any discussion? Hearing none, this is Vin. I'll vote aye.
Elliott, aye. Greg, you and I got it all at the same time, no matter what. Then it's scary. I have to abstain. I wasn't there, so. Okay,
but you still get the vote, though. So I believe everyone present on the call has voted. I've heard 3 ayes and 1 abstention. The minutes are approved. The next item is item 3, review of the governance calendar. And for, I think, the next few portions of the meeting, I will now turn it over to Devin to speak. I don't know, Devin, if the best way if someone has a question is to interrupt. Do you want to take a periodic pause for questions? I'll leave it to you to decide.
Thank you, Ben. So yes, this is Devin. I will pause periodically, but if I am not slowing down at the time that you want to ask a question, please don't hesitate to interrupt. I welcome all questions and comments. I am going to begin sharing my screen. So we are all looking at the same thing, although, Vin, are you able to see what I'm looking at, or should I give you page numbers so that you can refer to the page in the attached report?
I think I do not have the ability from my desk to share, so I'm merely on the phone. So to the extent that you can keep me in the loop, great. If not, I will follow along in the more traditional.
Okay.
Okay.
Great. Yep, I'll try to be cognizant of mentioning page numbers. So, as Vin said, this quarter the governance calendar has a focus on fees. So we review the investment management expenses as well as the other service costs. So FIA's advisory fee, the custodial fees charged by Wells Fargo. So we look at an all-in fee for the cost of running the program. As trustees of this pool of assets, it is one of your responsibilities to be aware of the fees that you're paying and to determine that they are reasonable. You know that FIA has a very large municipal pension base, so we service about 40 towns probably in the state of Connecticut, and then we also have a fair amount of Massachusetts exposure as well. So I can tell you that compared to our other municipal plans, these fees are reasonable. So right now I'm looking at page 8. The weighted average investment management fee of the portfolio is 46 basis points. FIA's consulting fee is, this is an asset-based fee as shown on this page. It works out to about 10 basis points. It actually is a flat fee, and it started off as a flat fee, I believe, $30,000, either 25 or 30, and then there is an annual inflationary escalator. So right now it's at about $31,000, which does translate to a 10 basis point fee on assets. Wells Fargo charges 3 basis points on assets. So all in, when you factor in the investment management fees, FIA consulting fee, and the Wells Fargo fee, you're looking at an all-in fee of 59 basis points, or 0.59%. So that's the cost of running the entire pension program. In terms of an actuarial review, as of the last time we met, we did not yet have the 2019 valuation, so we have now received that. Stefan is on the phone, so I'm sure he can speak up if I say anything out of turn or inaccurate. But according to the two most recent valuation reports, you can see the 2019 results as well as the 2018 data points. So the value of assets did increase from fiscal year 18 to fiscal year 19. The total accrued liability also increased. And you actually did bring down your return assumption. So it previously was at 6.625. You did make the decision to bring that down to a more conservative rate of 6.5%. And the funded ratio stayed about the same, so 89.6% funded. Compared to most municipal plans in the state of Connecticut, that's a very strong funded status. And also compared to most other municipal plans in the state of Connecticut, your return assumption is much more conservative and we feel appropriate. I think expecting to generate an annualized return of over 7% is a bit optimistic, especially given the strong market returns that we've experienced over the past 10 plus years. So I think that your return assumption at 6.5 is quite reasonable and prudent. So I will take a pause there. That's all we have in the governance calendar this quarter. It's very short and to the point. So I certainly entertain any questions, or Stefan, if you wanted to make any comments about the funded status or any valuation-related data points, certainly happy to have you pipe up.
No, I think I'm all set for right now, until they ask any questions specifically that involves funding.
Okay, wonderful. So I am moving on. I am looking at page 12 of the report now, Vin. So just, it seems like the first quarter was a million years ago. I think I've aged 20 years since the beginning of the calendar year between the markets and the mental impact of working from home with 2 children. And it's been quite a wild ride. So, as I'm sure you are all aware, unless you were paying no attention to headlines whatsoever, we had quite a difficult time in the markets over the first quarter. So we actually entered into bear market territory, the fastest time frame on history, on historical record. So historically, when we've entered into bear market territory, which is a loss of at least 20%, it's taken on average 116 days to get there. This time we got there in 16 trading days. So the peak of the market was actually on February 19th, and the trough was on March 23rd. So peak to trough, the S&P 500 lost 34%. Since that time, we've actually bounced back and regained 32% as of yesterday's close of business. So it was a very swift decline, the fastest on record, and a very sharp rebound as well. I think the rebound is the result of a variety of factors, not least of which was the government's response to COVID in terms of an economic response. So as you can see on the bottom of page 12, we had quite a lot of stimulus, and we had the government from both the congressional side as well as the Fed trying to prop up the economy, prop up the markets. So you see the breakdown of the CARES Act on the bottom left-hand side of page 12. So just as a reminder, the CARES Act was passed in the month of March, and it was a $2.2 trillion stimulus act that provided support to a wide variety of the economy, but corporate, small business, individuals. So, trying to help keep things afloat. Since then, there have been more stimulus packages, and there's actually a very large package that's currently going through the approval process in Congress. I'm sure that it won't reach the marketplace in its current state, but we do expect to receive further stimulus, which is likely to be quite substantial as well. So certainly you see a lot of support coming out of Congress. You see a lot of action by the Fed to try to help prop up the economy. So, of course, during the course of the quarter, they did reduce the Fed funds rate down to 0. You also see on the bottom right-hand graph that the Fed's balance sheet just really exploded in the course of the month. So we thought there was a lot of stimulus offered by the Fed during the global financial crisis, and that just pales in comparison to the stimulus that they injected into the economy in the first quarter. Trying to provide a source of liquidity, buying lots of assets, buying assets that they have never held on their balance sheet before. So certainly there's been a lot of support that's been offered by the government. When we look forward and think about what is likely to happen in the future, we don't, unfortunately, necessarily think that the worst is behind us. So, as I said, we've seen a very sharp rebound, S&P up 32% since the market bottomed on March 23rd. But the impact that COVID is likely to have on the economy is likely to be felt for quite some time. There are already a lot of conversations about a potential second wave of the virus. And that's particularly given what has been happening in other countries that are ahead of the curve based on our experience, who are several weeks or months in advance of us and have already started reopening and have seen second waves hit. So we, even as restrictive measures are being lifted, the potential for them to be reinstated, I think, is quite high. The comfort level with the American people of getting back to normal. Just think about a large sporting event or a concert. Even if you were allowed to go and participate in those types of activities, is that something you feel comfortable doing 3 months from now, 6 months from now, even 9 months from now? I think that the impact of COVID is likely to be felt for quite some time. And then, of course, there's the fact that we are not likely to have a vaccine until the early stages of 2021, and even then it needs to be widely available. I think expecting that the entire market downturn is behind us is probably a bit naive. And if you just look at the unemployment rate, unemployment went from a 50-year low with a rate of less than 4% to a 90-year high with a rate of 14.7% over the course of 1 month. Now, yes, it's likely that a lot of those individuals will be able to get back to work once this is behind us, but for small businesses that have been employing people, will those businesses still be intact? Will they survive this? So, I do think that the implications are likely to be far-reaching. Another thing is that, we're at the end of earnings season for Q1, and earnings have been very weak, as we would have expected. But what's really remarkable is if you kind of put things in context and think about what made up the first quarter. The first quarter was made up of 2 normal months of standard economic activity, and then 1 month with the shelter-in-place measures being enacted, and really less than a month, probably 2.5, 3 weeks. So if we think about the impact of earnings, the Q2 earnings results are likely to be much worse than If we look at it, if we look at that based on a PE ratio, price to forward earnings, the market actually looks very expensive right now. Because if you think about that ratio, so we have P, price, as the numerator, and then we have E, earnings, as the denominator. The earnings are falling, and price has been increasing over the past seven weeks or so. So we actually have stocks looking probably even more expensive than they looked at the end of the 2019 calendar year. So all that is just to kind of put things in perspective. Of course, we are thrilled with the market rebound that we've seen. We would love for it to continue higher, but I think expecting it to just continually move upward with no pullback, I think is perhaps a bit naive. So if we look at the index results on page 13, you of course can see that it's basically just a sea of red. And some of the trends that are obvious when we look at the results are that really investors fled to anything that resembled safety in the marketplace in the first quarter. So if we look at the domestic equity results and you compare the S&P 500 return of negative 19.6% to the Russell 2000 return, which was down 30.6%. So Russell 2000 represents small cap stocks. So you had 11 percentage points of underperformance from the small cap arena within equity markets. So investors were more comfortable staying with the larger cap names, which have a perceived measure of safety. Another interesting dynamic is when we look at the makeup of value versus growth. So value continued to underperform. Value has underperformed for the past 10, 11 years. As you may recall, we actually have a value tilt on the portfolio because style performance tends to be cyclical. So we've had a long period where growth has outperformed. It's our expectation that the pendulum will shift in the opposite direction. But the growth index is heavily weighted towards technology names, whereas the value index is more weighted towards financials, which were hit hard, and then some other areas, consumer discretionary names are higher in the value indexes. And so you see very strong relative outperformance by growth, because a lot of those technology names held up much better than the wide market. So if you think, you may have heard of the FANG stocks, Facebook, Amazon, Netflix, Google. They've actually expanded that name, added an extra A and then an M at the end, so now they're the FANGM stocks, which doesn't have quite the same ring to it. But Facebook, Amazon, Apple, Netflix, Google, Microsoft. That basket of stocks collectively was down only about 5% when the market was down about 35%. So the S&P 500, it has about 20% exposure to those names. So that's why you see the relative, the relative outperformance of the S&P. Whereas the indexes that don't have as much exposure to the technology sector and most active managers underperformed the S&P and in many cases underperformed their own benchmarks, because most active managers do incorporate at least an element of valuation to their process. So they look at how expensive or cheap stocks are relative to history, and they are less likely to invest in the stocks that look very expensive. Those FANGM stocks look remarkably expensive because they've really driven the market returns in recent history. And in fact, many active managers have maximum allowable weight within their portfolio. So oftentimes you'll have like a maximum threshold of 5% to any one stock. Well, Apple represents much more than 5% in the S&P 500. So just the makeup of the index, that led to a lot of active manager underperformance in the quarter, which is kind of an interesting dynamic. And then within fixed income, that was a big headwind for the portfolio. index had a return of 3% for 3.1% for the quarter. So you might look at this and say, oh, great, well, my fixed income at least held up and produced a positive return in the quarter. Well, not so fast, because if your fixed income managers had any exposure to spread products, so anything other than treasuries, those areas of the fixed income marketplace produced negative returns. And here's why. So in the first quarter, when you had this significant flight to safety, you had a lot of demand for treasuries, which pushed yields down. So just as a reminder, within fixed income, interest rates or yields and bond prices have an inverse relationship. So as yields come down, bond prices go up. So within the treasury market, when you had yields coming down due to increased demand, you saw an increase in prices. So if you had exposure to treasuries, you would have held up quite well. However, if you had exposure to other areas of the market, you saw a widening of spread. So spread is considered the incremental yield advantage for investing in a certain area of the marketplace that is not treasury. So it's the yield above treasuries. So investment grade credit is a spread sector. High yield credit is a spread sector. So you saw spreads widen. So as treasury rates were coming down, interest rates for the other areas of the fixed income market were actually going up, which meant that prices in those areas were going down. So you can see the high yield index had a negative return of down 12.7% for the quarter, as investors didn't want to have exposure to the riskier areas of the marketplace. You didn't want that credit exposure. You saw negative results from basically everything other than treasuries within fixed income. So it certainly was a difficult environment for basically any investor that has a diversified portfolio. There was really nowhere to hide within the quarter. Here on page 14 on the top right-hand side, you can see some of the dynamics I was talking about. So information technology, for example, again, very heavily weighted in the growth indexes, but not in the value indexes. That sector was only down 11.9%, whereas, for instance, financials, which is much more heavily weighted in the value sector, down 31.9%. Healthcare is another area. A lot of managers, particularly in the small cap indexes, you see a lot of exposure to like the pharmaceutical companies or biotech companies that are working on some of these unproven cures. So not only cures for COVID, but also working on other new drugs. A lot of active managers will not invest in companies that do not have a proven track record or proven growth, where it's just kind of a theoretical, they're working on some sort of new health technology. So a lot of times you see underweight exposure to those areas of healthcare, which actually held up quite well in the quarter. So you see healthcare is only down 12.7%. Of course, energy down very sharply in the quarter. Energy is a heavier weighting in the value index than it is in the growth index. It has almost no weighting in the growth index. So certainly some of the index sector weightings contributed to the dislocation that you see between value and growth. And then here's where you see spreads widening in the quarter. So I'm on page 16. On the bottom left-hand side, you can see spreads in the investment grade credit spiked up to 272 basis points. In the high yield market, they spiked up to 880 basis points at the end of the quarter. And historically, and this is something that we're going to be making a recommendation, just to kind of set the stage, if you look on the bottom right-hand side of page 16, you can see that historically, when spreads in the high yield space have widened out to 700-800 basis points, historically that's been a very opportunistic time to buy into the high yield environment, because because what happens is when you see spread widening beyond those levels, then historically yields do come down and come back into some semblance of balance. So again, as yields come down, that will mean rising bond prices. So that has happened over the past 20 years or so. We look and we see the times that historically spreads have widened out beyond the level of 800 basis points, is what's shown in this chart. And the subsequent return on both a 6-month and a 12-month basis has been very strong for investors who got into the high yield marketplace at those points in time. So I think that's just worth referring to. So I'll make a few more points about the capital markets before we move on to the portfolio. So page 17 really drives home the importance of staying invested in all types of market environments. So what the bar graph on the top left-hand side of the page shows you is if you had invested $1,000 in the S&P 500 index at the beginning of 1950 and you just let it ride for the next 70 years and then took that money out at the end of 2019, you would have been left with $192,000. And that annualized return is 7.8%. So that's just by investing the money on day one, never touching it again, taking it out at the end of that period. If you missed only the best 10 days of that 70-year time frame, you would only have been left with $93,000. So less than half of what you would have been left with if you were invested in all of those days. And your annualized return would go from 7.8% to 6.7%. And then so on and so forth. You can see the effect of missing the top 20, 30, and 40 best days. So you might look at this and then say, well, okay, that's fine. I just won't miss the best days. I'm only going to miss the worst days. So I'll get out at the top and then, get back in once markets calm down. And it would be great if anyone was able to do that, but typically that is not possible. And one of the reasons why it's so difficult is because historically, most of the market's best days have happened during bear markets. So most of the market's best days have happened during the worst times in the market. So in the table on the right-hand side of page 17, you can see of the top 20 trading days in S&P 500 history throughout the end of 2019, 15 of those 20 days happened during bear markets. So only 5 of them happened when things looked good, when investors were comfortable being in the marketplace. 15 of them happened at times like these when you're looking around and saying, gee, I feel really uncomfortable. Things aren't so good here in the market. And case in point, we actually added 4 new best trading days to that list of top 20 in the month of March alone. So I think that these statistics just really drive home the importance of not trying to time the market. No one has ever been able to do it effectively. You need to make 2 decisions, and you need to be both. You need to be correct on both fronts. One is when to get out, and then the other is when to get back in. And it just doesn't work. Historically, market timing has proven to be very ineffective. And the fact that this is a long-term pool of assets that you have been tasked with overseeing, it's just really important to stay invested in all types of market environments. And then the final thing I'll say is that on page 20, we show our market viewpoints. So as a reminder, the green bubble is where our current preference lies. The white bubble outlined in blue is the last time we had an opinion that's different from our current stance. And then the date underneath that is when we shifted our opinion. So we did make 2 shifts compared to last quarter. So we started off the calendar year with a preference for equity over fixed income. We have since moved that back to a neutral position. Unfortunately, we didn't anticipate COVID-19. I don't know anyone that did. So, of course, we do expect that the equity markets will continue to be pretty significantly volatile. So we no longer want to have that expressed bias towards equities. And then closer to the bottom of the page is we went from a neutral fixed income stance to a preference for credit. And again, that goes back to the comments that I made regarding the dislocation in the spread sectors of the fixed income marketplace and how spreads really widened, and it's our expectation that they will come back into balance. So any questions on anything that I went over in terms of capital markets? Okay, I will move on to the portfolio review. So if we look at page 22, the pension portfolio ended the quarter with assets at about $30.4 million. If we want, I guess I'll spoil the good news right now and bring up the most recent balances. So now the portfolio is at $32.5 million. So that's as of last night's close. So since the end of the quarter, the portfolio has gained $2.1 million, which represents a percentage gain of 7%. So we've gained back 7% of what was lost, which is, of course, we're happy to see that. All of the managers in the portfolio remain on maintain status, so there are no recommendations to replace a manager. None of these managers are on watch or terminate status. Oh, I'm sorry, that's not true. The Templeton Institutional Foreign Smaller Companies Fund is on watch status due to some organizational changes that they're having, so we're just keeping an eye on that. But all of the other managers are on maintain, and there are no recommendations to swap out any of the managers that you see on this page, on page 22. So here on page 23, we see the breakdown of the portfolio as of the end of the quarter. So between cash and fixed income, we were at about 37.5%, about 33.4% in domestic equity, 18.1% international developed, and 5.9% in emerging markets, and then about 5% to the commodities and natural resource equities, which we're lumping the principal fund into that. So on page 24, this is where we can see the performance of the plan. So as I already mentioned, it certainly was a difficult quarter from both an absolute and a relative perspective. Down 16.4% for the quarter, substantially behind the benchmark, and the primary reason for the underperformance relative to the benchmark was the exposure to the spread sectors within fixed income. So whereas the Barclays aggregate index, which is represented in your benchmark, had a positive result for the quarter, your fixed income managers collectively were negative because of that exposure to investment grade credit, high yield credit, corporate securitized fixed income instruments, some global bond exposure. So all of those things were headwinds. And then, of course, we do have a value tilt within the domestic equity portion of the portfolio. And then we have dedicated small cap on both the domestic side and the international side. So all of those things were headwinds for the quarter. You can see on a very long-term basis, so looking back at the long history of the plan going back to 1980, you still have an annualized return since inception of 7.7%. So above your current interest rate assumption of 6.5%, but the most recent quarter has definitely taken its toll on the recent results. Even looking at the 5-year and 7-year time frame, those returns are much more muted than they were last quarter, and it's all due to the first quarter with this sharp downturn we saw. So I won't go into every single manager strategy on pages 25 and 26, but just as a reminder, so we do show asset class results, composite results. So for instance, fixed income you can see shown in the gray bar towards the top of page 25. So that result you see there of negative 2.7% for the quarter, whereas the benchmark was up 3%. That negative 2.7 is your 4 fixed income managers collectively rolled up. How did they perform? The aggregate result was down 2.7%. Again, that is largely due to the spread exposure. So you can see the NetWest fund is the most conservative of all of the fixed income managers. That will have the most exposure to treasuries, although they are still underweight relative to the Barclays Aggregate Index. So comparatively, NetWest held up the best. We actually had a positive result from that. As a reminder, the number that you see in parentheses is the percentile ranking. So the lower the number, the better. So NetWest ranked in the top 15% of the peer group of other core plus fixed income managers. Now, Prudential is much more credit focused. So their underweight to treasuries is much more substantial than NetWest. So we actually had negative results from the Prudential Total Return Bond Fund. And then you had a much sharper negative results from BlackRock and from Brandywine, the two diversifying strategies within fixed income. So BlackRock has a substantial amount of exposure to structured assets, to securitized assets. They have almost no treasury exposure. They have a much shorter duration profile, which in this environment was not beneficial. And then Brandywine has a lot of exposure to currencies outside of the U.S. So in an environment where you had investors fleeing to safer asset classes, the dollar actually did very well. You had a very strong dollar. Brandywine has exposure to currencies other than the dollar, and that was the primary source of Brandywine's underperformance. I think it's important to note two things. One is the weight in the portfolio. So the two kinds of anchor bond strategies are NetWest and Prudential. They both have a 13% target allocation in the portfolio. BlackRock has a 5.5% target, and Brandywine has only a 3.5% target. So even though you see the results on this page, and Brandywine's really stand out, when you think about that in terms of the larger portfolio context, and remember that it's only a very small weighting in the portfolio, I think that does provide some measure of comfort. But we still do continue to think that diversified fixed income exposure makes a lot of sense. If you think about the 10-year treasury right now with a yield of 70 basis points, if you strip out inflation, you're looking at a negative result. So really the only thing that treasuries can provide in a portfolio is liquidity and safety, but you're not going to get any sort of return from treasuries. You need to look outside of the treasury market and get diversified fixed income exposure. So just certainly acknowledge that it was a big headwind in the quarter, but we do think that it makes sense moving forward. Domestic equity, you see some modest underperformance relative to the benchmark. That segment of the portfolio was down 23.3%. Benchmark was down 22.5%. You have two passive strategies. So you've got the Vanguard Institutional Index, which just replicates the S&P 500, obviously in line with that index in the quarter. Then you have the Value Index, also in line with that value index, but of course, a reminder that value strategies underperformed growth strategies. So you do have relative underperformance if we're comparing it, for instance, to the S&P. And then the dedicated small and mid-cap exposure, so you see Diamond Hill on the bottom of page 25, and then the Atlantic Capital Fund on the top of page 26. Small cap exposure was a very significant headwind as we had the flight to safety in the quarter. And then specifically some of those sector dynamics came into play. So Diamond Hill, for example, had an underweight to healthcare and information technology. So that's why you see some negative relative performance. And then the Eaton Vance Atlanta Fund happens to have less of a growth profile than the index. So again, growth stocks really outperformed blend or value stocks, so that's why you see the relative underperformance. I don't want to bore you with details for every single manager strategy. I'm certainly happy to talk about all of them if you have questions. One thing that I think is worth pointing out is if we look at the since inception column on pages 25 and 26, and you pay attention to the numbers in parentheses, so looking at the peer ranking, for most strategies in the portfolio, you see a ranking above median, so better than half of the peer group, and in many cases, you see a ranking in the top quartile. So one exception is Brandywine. Again, that looks very different from the benchmark. You have a lot of currency exposure, and that has not held up well compared to the peer group long term. But with the exception of Brandywine, you have NetWest, Prudential, and BlackRock all landing in the top quartile of the fixed income peer group that is appropriate for them. On the domestic equity side, you have very strong peer group rankings on a since inception basis, basically in the top third for all strategies. On the international equity side, you have the Templeton Institutional Foreign Smaller Companies, which is just below median, but the other results are above median. And then the Principal Diversified Real Asset Fund is, all we have is the performance since the beginning of this year because it was added to the portfolio in December. So that lags its benchmark slightly. But when I actually pulled up the results of the fund that replaced, as a reminder, we had the VanEck Global Hard Assets Fund in the natural resource equity column. The VanEck fund was actually down almost 40% for the quarter. So we are definitely happy that was no longer in the portfolio. So again, we have no recommendations to replace any of these managers. We acknowledge it was a difficult quarter for the portfolio specifically and for active management generally speaking. But we think that long term, these managers are likely to add alpha over time.
That was one question. This is Elliot.
Yep.
No concern with the Atlanta Capital manager, just maybe a comment or two on the performance there, just because I understand they're under exposure to growth relative to peers and index, and if memory serves, it's really at the expense of quality, which is comforting.
Exactly.
But generally, I think you'd expect to see them do better in sell-offs. Now, this one's pretty unique, but just a thought or comment there would be helpful.
Yeah, that's a great question, Elliot. And normally, a lot of the managers that we would expect to provide downside protection over time did not provide that protection in the first quarter because the sell-off was so swift. If we look at the 5-year results of the Eaton Vance Atlanta Fund, so at the top of page 26, it's more than 2 percentage points ahead of the benchmark, ranks in the top third of the peer group. And then actually, if we look, I don't know what these statistics are, but I expect that they are good. The upside-downside capture ratio. Yeah, so it's interesting. If you flip ahead, or you don't have to, you can just listen to me. On the bottom of page 63, the bottom right-hand side, we have the up market capture ratio and the down market capture ratio of the last 3 and 5 years. So what's interesting is they don't capture nearly all of the upside. So on a 5-year basis, the upside capture ratio is only about 87%. So again, when markets are performing really well, they'll do well, but just not as well as the market. But the downside capture ratio is only 74.2%. So they do have a history of protecting on the downside, but
right.
You're 100% accurate that in the course of this quarter, that was not the case.
Yeah, just curious, what drove that?
Yeah, it really was the growth less growthy atmosphere. So it was overweight financials. So again, compared to the growth index, that is not the standard profile. And then some of their stock selection in information technology was not as strong as the benchmark. So, but no, we're not concerned about that fund longer term.
Me neither.
Right. Yep. That was a good question, though. Any other questions before we move on to the portfolio recommendations?
Devin, this is Vin. Just more of an observation than a question. You spoke at length about Brandywine.
Yes.
Just my observation is simply that since inception, this fund has been in the bottom quartile since inception, and with no period of time indicating any redeeming qualities for the fund. So I agree with the strategy. I'm not necessarily certain that this is the right partner based upon their performance to date, and that's just my comment.
Yeah, no, that's a valid observation, Ben. If you look at page 50, you can see the calendar year results over the last 4 years, which I think kind of put things in context, relatively speaking. So Brandywine Brandywine does not behave like the benchmark. I guess that also translates to it not behaving like other members of its peer group. So if you look at the 2019, 18, 17, and 16 results, you either have very significant outperformance or very significant underperformance. Never do you have results that are in line with the benchmark. So 2019, 4 percentage points ahead of the benchmark. 2018, about 4 percentage points behind. 2017, about 5 percentage points ahead. 2016, 3.5 ahead. So this one quarter's experience has actually kind of taken away the performance advantage that it had. If you'll bear with me, I'm going to pull up the fourth quarter report, because last quarter, the Brandywine was actually one of the strongest performers and looked very good relative to the peer group. So it really does kind of call to mind, how important a point of time reference is. So if you just bear with me.
Vin, while Devin's looking for that, this is Elliot. I'll say that I have my own biases, obviously, about strategies and managers, but I think Devin's point about when we're measuring this and endpoint sensitivity is well taken, and Brandywine's someone that I've always viewed as best in class in this space.
Okay, thank you, Elliot.
Thank you, Elliot. That's helpful. Can everyone see my screen now where we have the December 31st results? Yeah, so if you look at the Brandywine in that last quarter, they were almost 5 percentage points ahead of the benchmark, ranked in the top first percentile of the peer group. 4 percentage points ahead on a one-year basis, top quartile. On a since inception basis, they were about 1 percentage point ahead, and basically in the top third of the peer group. So it really the end point does have a big impact. And I acknowledge this quarter's underperformance was massive, and that's what's having the impact on the longer term track record.
And this is Vin again, Devin. Then I guess because we highlight in the manager performance overview the quartile, maybe there needs to be some sort of asterisk or footnote next to Brandywine to explain, because I think to the layperson who doesn't have the benefit of your explanation and Elliot's knowledge, I mean, on the face of it, it would appear that we're not doing our due diligence staying with a firm that is in the roughly the 10% quartile since 2013. So that's real. I just think the optics of it don't translate favorably. Your explanation does, but not looking at it in the traditional sense of ranking it from a quartile perspective.
Okay, that's a fair point then.
Yeah, is there one way to maybe look at it? Like, I know we've prepared stuff in the past to see like kind of a rolling ranking, so you can see like where it ranked on like rolling quarters. And I think if you looked at it that way, you would see that it more often than not is above median and probably top quartile, as frequently, if not more frequently, than bottom quartile.
Yeah, that's a good point, Elliot. So here on page 50, we show, we do show rolling ranking.
Yeah.
Yes. So Ben, I think that could help. So you see the blue boxes, so I'm looking at page 50 on the bottom left-hand corner.
Okay.
And you'll see the blue box represents when the 3-year ranking is above, you see if it's above the yellow dot, that means it's above the World Government Bond Index. And then anytime it's above that line of 50, that means that it has ranked in the top half of the peer group. So in most cases, this 3-year ranking is above median. And it's only in the recent time frames where you see it below. So I think that does, unfortunately, a lot of these pages, so for instance, the page where we show the ranking earlier in the report is not manually constructed, so we don't have that much flexibility with regard to what we can and cannot show. But I do think, to Elliot's point, seeing the rolling ranking makes you think, oh, okay, I see that in recent history, it doesn't look great. Most of the time, it's in the top half of the peer group according to history.
Yeah, it just shows the experience more accurately than like a particular point in time.
Okay. Agreed. Thank you both.
You're welcome. Okay, any other questions? All right, so I will skip ahead to the portfolio recommendation. I've already kind of set the stage for this, but I have moved ahead to page 86 of the report. So ultimately, our recommendation is to add an allocation to the PIMCO high yield strategy. So again, this goes back to what we see as a dislocation in the high yield market. Spreads have widened beyond what are average or what we think are reasonable levels. And we think that it is appropriate to initiate what we really view as kind of a tactical allocation. So we don't anticipate that 3 or 4 years from now, we would still have this high yield in the portfolio. We think that it's likely to be something that will perform well over the next couple of years, and then quite likely we would roll it off. So our recommendation is to add a 3% allocation to the PIMCO high yield strategy. We would source that by taking 1% each from NetWest and Prudential total return bonds, and then taking 50 basis points each from BlackRock and Brandywine. So ultimately, the overall profile of the portfolio remains the same, with 35% allocated to fixed income and then 65% allocated to risk assets. But the makeup underneath the hood of the fixed income portfolio is slightly different. Now we have some supporting data on PIMCO here at the back of the report, but just to give you kind of a broad sense, PIMCO is one of the more conservative managers within the high yield space. So high yield starts at BB as being the highest quality high yield sector, and then it goes down from there to even exposure to CCC or to D rated companies. PIMCO has most of their exposure comes through the double B marketplace, so the highest quality segment of the high yield. And when they do their research, PIMCO is a very well-known name in the fixed income space. They have a lot of experience and a very strong track record when it comes to credit research and fundamental research of bonds. And they also are very focused on liquidity. So they want bonds that are very widely traded, that are not going to be thinly traded. So when they need to liquidate something, they can't sell the bond in the marketplace. So they're focused on liquidity, focused on credit research, and the highest quality area of the high yield marketplace. We have some data points kind of supporting the recommendation to add exposure to high yield, but basically it is the dislocation in spreads, the fact that the market is pricing in basically the expectation that almost half of all high yield companies will default over the next 5 years. We think it's likely that there will be an increase in defaults, but we don't think that half of all high yield companies are likely to default. So as long as there are fewer defaults than, kind of what's priced into current spread levels, then we should be able to generate very strong returns from this type of an allocation.
So Devin, I have some thoughts on this recommendation. This is Elliot. So I understand the rationale for the recommendation, certainly, but in talking about like a bond portfolio that's our total bond portfolio that was down about 3% this quarter relative to the index, which is mostly investment grade, which was up 3%. I understand the reasons for it, and it's the credit exposure in our existing bond portfolio. Given the uncertainty that was discussed at the outset of the call around something totally unknown and new to all of us with coronavirus and potential second wave and longer-term economic impacts. I mean, I agree with all of that, and I just think there's some uncertainty around making changes and allocations to new managers, particularly where the existing managers have underperformed because of the credit exposure that they hold. And I know some can hold up to 20%. Some have more. I think BlackRock has more credit exposure. So I'd expect those managers to do well and capture those spreads themselves and bounce back and make up the underperformance that we experienced in Q1. So I want to express some hesitance to a dedicated allocation to this, where I think we have it within our existing managers. And I wouldn't penalize those managers for the underperformance in Q1, but I would expect the trade to work on the other side in our favor.
Yep, that's fair, Elliot. There is not a ton of exposure right now in the current strategies, but you're right that they do have the flexibility to increase the high yield exposure above levels where they are right now. So the likelihood is that they're seeing the opportunities in the space as well. And I would expect to see those high yield levels within the managers that are currently being used. I would expect those levels to increase. So that certainly is something to think about. This is the type of strategy where we could see, like you saw on the index returns page, high yield was down 13.7% for the quarter. You could see results from that in the short term before the long term, kind of return to normalcy plays out. So if there's not an appetite to take any additional risk in the fixed income portfolio, we certainly that's fine, and we understand that position, and would be comfortable with sticking with the current roster of managers. It's an opportunity, but if you don't want to do the reach for yield, then we're fine not having it in the portfolio as well.
Yeah, I just wanted to express my concerns, and there is some concern, but I think it warrants discussing, and I think certainly keeping an eye on, if we don't vote to do this meeting, I'd love to discuss it in the future as well.
Thank you for that. Does anyone else have comments or preference differences?
I guess this is Vin. I guess to build on Elliot's comments, I guess, again, not being as sophisticated as Elliot's knowledge, or nowhere near as sophisticated in terms of my knowledge, I guess what I was having difficulty reconciling is just the concept of change at this point, given that we're changing within a somewhat unprecedented environment and uncertain, how all this I don't know, this whirlwind is going to impact our portfolio. And I guess from my own perspective, it was just a matter of not feeling comfortable with another layer of change now. And maybe that's more of a personal issue, but it's translating into how I view the portfolio, in that I'm uncertain that a change in an environment of extreme, unprecedented change is warranted at this time. So I guess from my perspective is that if the board wants to consider this, we can certainly vote on it today, but it's my own sense that we have a chance to digest this, and if the board would like to meet prior to December, even to talk about this one item and have a special meeting just to talk about this one item, and you can certainly proceed. But again, I will, if the majority of members want to proceed and approve, I certainly will be willing to make the motion to do so.
Of course, welcome comments from other members as well. I would just say that it is not our intention to pound the table on this and kind of force you or strong arm you into adding an exposure in the portfolio that you're not comfortable with. As trustees of these assets, you need to be on board with the strategies that we have. We have implemented it in a lot of client portfolios, but there are also some clients that we brought it to and they said, just as you're saying, not really, I understand the rationale behind it, I understand the data points, but I'm not comfortable with it provided to getting that additional risk exposure in the portfolio at this point in time, and that's fine. We want everyone to be comfortable. We certainly can table it and potentially revisit it at another time. I will say that spreads have actually tightened a bit since the end of the quarter. So they ended the quarter at about 880. Now they're closer to 700. So, we have already seen some of the opportunities kind of be taken off the table. Still, we think compelling spreads, but I suspect that 6 months from now, this would not really be a good opportunity. Which is not to say that you should jump on it now. It's just to say that it's likely not going to be a recommendation further down the road. But again, I hear what everyone's saying, and if there's hesitation, then I don't think we should do it, because it does increase the overall risk exposure of the portfolio.
Yeah, I think this is Elliot again. To your point, Gavin, this is something that I appreciate the idea and you bringing it to us. That this is something that could be very quick, and we could be talking in a few months and say that was a great opportunity we missed. So I want to recognize that as well. But just with the uncertainty and the credit exposure elsewhere in the fixed income portfolio, just less certain and favor caution personally anyway. But it could end up being a great idea.
So I guess this is Tim. I would support us looking at it in a couple months, having another special meeting. I think this market is going to go south, not north. I think, Devin, your point that we haven't seen the worst, I think that is probably fairly understated. Maybe I'm the pessimist in the group, I don't know, but I think it's going to I think you're going to see a lot of defaults. And I think that while this is attractive, for all the reasons Elliot stated much more eloquently than I'm probably would be more prone to holding off, because I think as a small business owner, I don't think the worst is even close to hit yet. Was that bright and cheery enough for you?
Yeah, so not everybody's frightened into silence. This is Vin. I think that, and Craig is on the call. Craig, would you like to add anything?
Well, I would just say that I'm ambivalent about it, but the reason being is that we just don't know which way things could go. So it sort of seems, in my mind, it just lacks support to make that decision. So I would be tempted to just stay the way things are. It just feels a little bit like a roll of the dice.
Okay. So if I could, this is Vin, if I could just briefly summarize, Devin, and I think it's the consensus of the board that is a good idea. Certainly welcome any opportunity, but I believe the consensus of the board is to table any action on this item until a future meeting.
Great, sounds good to me.
Okay, and again, this is Vin. Just thank you, Devin, for walking us through. If you could at some point put a couple of hard copies of your presentation in the mail to us at Town Hall, so we can have it for the file in case an interested party has an interest in wanting to look through it.
Okay, we'll do that then. Thanks.
Okay. That leads us to item number 7. As some of you may be aware, is that I will be retiring from the town of Stonington effective Tuesday, May 26th. And just permit me to provide some background. Just before Christmas of last year, my wife was diagnosed with breast cancer. And so we are about 5 months into her treatments. And we've both agreed that it's time to step away from both of our respective careers. She as an educator, my being, of course, here as a Director of Administrative Services. So I have been out for quite some time during her first portion of her treatments, and have returned for last week and this week to kind of wrap things up. So I did submit my letter of resignation, not only as chair, but to the board this week to the first selectman. I would be reticent to not thank all of you, as well as your predecessors, for all your contributions in terms of not only participating on this board, but also in providing me with expertise well beyond things that I have become knowledgeable of through my interactions with you. So my thanks to all of you, my best wishes to each of you individually and collectively for your continued good health and success. And before we can conclude this meeting, if someone would like to step forward as a temporary chair to act as a point of contact before my successor comes into this role, it is my recommendation to the first selectman that the person who sits in this office also acts as chair of this board, primarily for administrative reasons, because it provides, for example, Donna, Devin, Bruce, etc., a central point of contact within the town hall, which I think is advantageous to everyone. So with that, again, my thanks to you all. And if there's someone foolish or bold enough to step up as temporary chair, we would entertain that now, and then of course we would vote on it and then adjourn. And having heard none, and that's certainly fine. It's just that as long as everyone understands that the search for my position, my understanding that it closed last Friday, so you're probably looking at maybe a 2-week period to review. And I have no idea who was applied, and I have not asked simply because I don't think that's appropriate. But you're probably looking at least I would say a 4-week interval of being chairless. So to the extent that issues arise, then you'll need to be comfortable with the fact that you would not potentially be able to convene, or you could convene, but it may take a little more of an effort than it might be. So again, not meaning to put any of you on the spot. I just thought if someone had a desire to do this, I would provide that opportunity, but certainly understand with everything else going on in your lives that this would not be the cherry on top of the sundae. So what I will do is I will move on and ask for a motion.
Dennis, Tim, I'll volunteer to do it. I'm going to be in town hall a lot over the next 4 weeks anyway, so
Okay.
I'll volunteer to do it in the interim basis, and also with the knowledge that I would support whoever replaces you take over as chair once they're in and situated.
Okay, so I will make a motion to nominate Tim O'Brien as temporary retirement board chair. Do I hear a second?
Second, it's Elliot.
All those in favor? Vin, aye.
Aye, Craig.
Aye, Elliot.
Hi, Gary.
I state your name. Animal House state.
Okay. Well, Tim.
Yes, aye.
All right, Tim. Thank you, Tim, very much for at least being the point of contact. We'll try not to have this be too much of a burden, but certainly appreciate your willingness to do so. So with that,
And this is Craig. I mean, maybe I guess thank you for your service first of all, but maybe this also points out the fact that at some point we could have some sort of governance guidelines to handle vacancies or something in the future. Just sort of a line of succession, something to think about again for the future.
Yeah, and Craig, this is Vin. It is on the list of things that the future board should take up that Donna and I have talked about. So I think this is something that we need to put in place, and would certainly invite a discussion with Bruce Barth to see what the logistics, both administratively and legally, that we would need to do in order to do that. So your point is well taken.
Yeah, I have one question, I guess, for everyone. So I will have changing contact information starting in June. So I've resigned from my current role at O'Shaughnessy and accepted a role with a new firm to start their business here in the States. So that's all in flux through the end of the month. So I just want to go through the right channels. I wanted to communicate that to everyone, but go through the right channels and getting everything updated. And Tim, I'll be joining you by Town Hall as well, since we're actually moving at the end of the month. When it rains, it pours. So, but we're moving just down the street from Town Hall on Elm. So I'll be over there with you.
I was going to stop by your front porch for a lemonade.
Yeah.
Let's say lemonade.
Yeah, at the appropriate distance.
Yeah, you're gonna have to notice those meetings, guys. Okay, just so that you know. No, I'm just kidding. But congratulations. Your new contact information, Elliot. I would just forward it to Donna, and Donna, if you could just make sure it gets out to members. Okay, so thank you all, and if I could have a motion to adjourn.
So moved, Craig.
This is Vin, I'll second it. All those in favor, Vin, aye.
Aye, Craig.
Elliot, aye.
Gary, aye.
Okay, the motion is carried. Thank you all, and if you're ever in Essex, don't hesitate to come on by. Thanks very much.
Thank you.
Right, bye-bye.
Thank you, everyone.
Right,
Thanks,
bye-bye.
Devin.
Yes.
Thanks, Devin.
Thanks, Devin. Right, bye-bye.
Thanks, everyone. Bye-bye.
Goodbye.